In this video course, you will learn everything you need to know about the RSI indicator. To create this course, we collected insights from all over the internet and tested it in real markets to discover 5 proven RSI trade setups. Then we added 3 confluence filters to these setups to create 15 profitable trading strategies to trade every market condition. And we are about to reveal it all. This video covers everything, so watch the full video to grasp every concept in detail. By the end of this video, you will become a pro trader with a set of proven, ready-made strategies to conquer any market, be it stocks, forex, or crypto. And if you're ready to go beyond this video, the Prime Traders program gives you a lifetime access to the Price Action course, Indicators Mastery course, and the Advanced Strategies course, where we cover 25+ trading strategies built for real-world profits. Links are in the description, so check it out. According to Investopedia, the Relative Strength Index is a momentum indicator that measures the speed and magnitude of the security's recent price changes. In simple terms, it compares the price change on green candles against the red candles. To plot it, head over to TradingView and open the Indicators tab. Then type in RSI and select this option. Once plotted, the RSI will look something like this. There are 3 main components here: the RSI line, the overbought zone, and the oversold zone. Here, the purple line is the actual RSI line. It revolves anywhere between 0 and 100. A simple way of understanding this is if the RSI line is moving up, it indicates a bullish momentum. It signals that the price has an upward movement bias. Similarly, when the RSI is moving down, it indicates a bearish momentum. It signals that the price has a downwards movement bias. Next, we have the overbought and oversold zones. These are areas on the extreme ends of the indicator. By default, the overbought zone is set to 70 and the oversold zone is set to 30. When the RSI line moves into the overbought zone, it suggests that the buyers have pushed the prices up by a large margin in the short term. This could lead to a downwards reversal or a short-term correction. Similarly, when the RSI line moves into the oversold zone, it indicates that the sellers have pushed the prices down by a great margin. There is a good chance of an upwards reversal or a small upwards correction. The overbought and oversold zones can be accurate in a ranging market. However, in a strong uptrend, the RSI can stay overbought for a long time before reversing downwards. Similarly, in a strong downtrend, the RSI can stay oversold for a long duration before reversing upwards. Therefore, you cannot trust RSI indicator blindly. Now let's take a look at the 5 trade setups of the RSI that can actually be trusted. Setup number 1, RSI Pullbacks. As we discussed before, the price will not always reverse from these overbought and oversold zones. However, through our testing, we have found an RSI level where the price will actually reverse, and that level is the 50 level. In an uptrend, the price will often stay above the 50 level. Once we identify such a market phase, we wait for the price to pull back. When the pullback happens, the RSI will move below the 50 level for a few candles. The 50 level acts as a lower limit for the uptrend. If the price is to continue the uptrend, the RSI has to stay above the 50 level. If the buyers are active, the RSI will quickly reverse back above the 50 level and the price will trade higher. So buying at the 50 level is a good trade setup. An important point to note here is that if the RSI stays below 50 for 8 to 10 candles, it's a sign that the uptrend is probably over and the buy trade should be avoided. In a downtrend, the price will often stay below the 50 level. Once we identify such a market phase, we wait for the price to pull back. When the pullback happens, the RSI will move above the 50 level for a few candles. The 50 level will act as an upper ceiling for the downtrend. If the price is to continue the downtrend, it needs to stay below the 50 level. If the sellers are still active, the price will quickly reverse back below the 50 level and the price will trade lower. So selling near the 50 level makes sense. Setup number 2. RSI Divergence. It is extremely difficult to identify reversals using the RSI because there is no defined level where the RSI will reverse. For instance, sometimes the RSI can stay above 80 without any pullback, while other times it can reverse after touching 60. However, we can use RSI divergence to identify high probability reversals. A divergence occurs when the price and the RSI move in different directions. A bullish divergence occurs when the price makes a lower low, but the RSI makes a higher low. It indicates that the momentum on the second down move was lesser compared to the first down move. In other words, the sellers have become weak. Therefore, there is a high probability that the price will give us a substantial up move. So it is a good buy setup. A bearish divergence is the reverse. It occurs when the price makes a higher high, but the RSI makes a lower high. It indicates that the momentum on the second up move was lesser compared to the first up move. In other words, the buyers have become weak. Therefore, there is a high probability that the price will give us a good down move. Setup number 3. RSI Hidden Divergence. The hidden divergence is a little different than the regular divergence. Regular divergence helps in identifying reversals, while the hidden divergence help in identifying strong pullbacks. A bullish hidden divergence occurs in an uptrend. In an uptrend, the price will generally make higher highs and higher lows. The hidden divergence occurs when the price makes a higher low, while the RSI makes a lower low. It shows that the sellers had to push harder for this pullback than the previous one. In other words, the buyers are becoming a bigger challenge for the sellers. Therefore, it is a strong possibility that the buyers will take control of price and push it higher. Similarly, a bearish hidden divergence occurs in a downtrend, where the price will generally make lower highs and lower lows. The hidden divergence occurs when the price makes a lower high, while the RSI makes a higher high. It shows that the buyers had to push harder for this pullback than the previous one. In other words, the sellers are becoming a bigger challenge for the buyers. Therefore, it is possible that the sellers will take control of price and push it lower. Setup number 4. Trendline Breakouts. Trendline breakouts on the RSI are a powerful way to enter early into large price moves. Throughout our analysis and testing, we found that if we drew a trend line on the price and the RSI for the same price pattern, the RSI gave a breakout before the price in 7 out of 10 breakouts. In an uptrend, we can create a trend line by connecting the higher lows on the RSI. When the RSI breaks below the trend line, it indicates a possible reversal to a downtrend. Therefore, it becomes a good sell setup. We can also draw trend lines on the pullbacks of the trend in order to enter the existing uptrend. In a downtrend, we can create a trend line by connecting the lower highs on the RSI. When the RSI breaks above the trend line, it indicates a possible reversal to an uptrend. Therefore, it becomes a good buy setup. We can also draw short-term trend lines on the pullbacks to enter an existing downtrend. Setup number 5. EMA Crossovers. The EMA crossovers on the RSI are a mechanical approach to identifying potential reversals in the price. For this, we plot a 10-period moving average on the RSI and wait for it to give us a bullish or bearish crossover. A bullish crossover occurs when the RSI line crosses above its 10-period moving average. It indicates an upwards reversal in price, and it is a high probability buy signal if the crossover occurs around or below the 30 level on the RSI. Similarly, a bearish crossover occurs when the RSI line crosses below its 10-period moving average. It indicates a downwards reversal in the price. It is a high probability sell signal if the crossover occurs around or above the 70 level on the RSI. So these were the 5 high probability trade setups using the RSI indicator. Now let's add a few confluences to these setups to create a complete trading strategy with even better accuracy. The setups and strategies discussed in this video can be used on any chart and any time frame, but for the purpose of this video, we will use it extensively on the 1-hour chart because it suits our trading style. Strategy number 1, RSI plus key levels. In this strategy, we are going to combine our RSI setups with the levels of support and resistance to make trade decisions. Here is an example where we combine the RSI pullbacks with support and resistance. On the bottom of the chart, we have the RSI with the 50 level marked. If we focus on the left side of the chart, we see that the price was in a downtrend. The price was moving down and the RSI also stayed below the 50 line. There was a momentary pullback here, but other than that, it was a bearish chart. On this pullback, we see the price get rejected twice from this area, so we mark this as a resistance level. When the price comes back up, there is a small rejection at the resistance, but the price breaks out. If you are familiar with the concept of support and resistance, you will know that once broken, the resistance becomes a support level. Now, if the price were to pull back to this level, we expect the buyers to come and take the price higher. We also notice that the RSI is now trading above the 50 line. It signals that the price is in an uptrend. The price makes a strong move up after the breakout, and then we see a pullback. The pullback brings the price to the support level, and the RSI also moves below 50. We have a confluence of the RSI pullback setup with the support level, so it is a good trade setup. We want the RSI to quickly move above the 50 to enter a buy trade. On this candle, the RSI moves above the 50 level, and we enter a buy trade on the close of this candle. We keep our stop loss below the support and target a 2:1 risk-reward ratio. Here is another example where we combine the RSI Hidden Divergence with key levels. The price is in an uptrend, creating higher highs and higher lows. It found resistance here before breaking above it. So we mark this level, which has turned from resistance to support. This up move eventually rests and leads to an orderly pullback. The price moves closer to the support level, where we notice a hidden divergence. The price has created a higher low, while the RSI has created a lower low. This is a bullish hidden divergence. The support and the hidden divergence both indicate a potential up move. So when the price goes back above the support level with this big green candle, we enter a buy trade. We keep our stop loss below the support level and target a 2:1 risk-reward ratio. Here is a sell trade using the RSI Trendline Breakout setup with the key levels. We see that the price reversed downwards from this price level, so we mark it as a resistance. The price then makes another up move coming into the resistance level. We mark a trend line on the RSI for this up move. Sellers enter at the resistance level again, and we are ready for a sell trade. We enter a sell trade when the RSI breaks below the trend line. It indicates a downward shift in momentum. We keep our stop loss above the resistance level and target a 2:1 risk-reward ratio. Strategy number 2, RSI plus Fibonacci. Fibonacci retracement levels help identify with high precision where price pullbacks are likely to reverse. To do so, we use the Fibonacci retracement tool and plot it over an upwards or a downwards price move. Then we look at the 0.5 and the 0.618 level. The area between these two levels is known as the golden zone. Majority of pullbacks end at this point, so it's the area where we should try to catch the next move. In an uptrend, we plot the retracement on an up move, and the golden zone becomes an area to look for buying opportunities. Similarly, in a downtrend, we plot the retracement on a down move, and the golden zone becomes an area to look for selling opportunities. Now let's combine this knowledge with the RSI setups to catch profitable trade opportunities. For this example, we are combining the Fibonacci with the RSI Trendline Breakout setup. Here we see that the price was in an uptrend and it created this strong up move. We draw the retracement tool from this low to this high. We then wait for the price to pull back. Once price reaches the golden zone, we draw a trend line across the RSI for that pullback. The price bounces from the golden zone and starts to trade up. Our entry occurs when the RSI breaks above the trend line on this candle. We keep our stop loss below the golden zone and target a 2:1 risk-reward ratio. Now this is the strategy on paper, but if we look closely, we can see that there is a support level in this exact area that was once a resistance. We can also draw a trend line stretching from these 2 points that coincides with this pullback. When multiple concepts line up like this, it usually leads to powerful moves. And that's exactly what we cover in our Prime Trader program. We first teach the basic concepts of price action and indicators in individual modules. Then, we combine these concepts and share more than 25 different strategies that can be traded in any markets on any time frame. All of these modules are available inside our Prime Trader program. Click the link in the description to check it out. Moving on to the next example, where we combine the Fibonacci with the RSI Divergence. We spot an up move here, and we draw the Fibonacci retracement tool. The price pulls back and creates a bullish divergence. We have a lower low on the price, while the RSI shows a higher low. It's a classic buy signal, so we plot a trend line on the RSI for the pullback. We can also plot it on the price and wait for the price and RSI to both break their respective trend lines. Once that happens, we enter a buy trade. We place our stop loss below the golden zone and target a 2:1 risk-reward ratio. Here is a sell trade where we combine the Fibonacci retracement with the RSI pullback setup. We spot a down move in a downtrend. We draw the Fibonacci retracement tool from this high to this low. When the price pulls back to the golden zone, we realize that the RSI has also pulled back to the 50 level. It's a confluence between the Fibonacci and the RSI that both signal a potential down move here. So we enter a sell trade on this candle as the RSI breaks back below the 50 level. We place our stop above the golden zone and target a 2:1 risk-reward ratio. Strategy number 3, RSI plus moving average. A moving average is a simple indicator that calculates the average price of an asset over a given number of candles. For our strategy, we will use a 50-period simple moving average. It helps us in identifying the trend of the markets. If the price is trading above the moving average and the moving average is sloped upwards, it indicates that the price is in an uptrend. Similarly, if the price is trading below the moving average and the moving average is sloped downwards, it indicates a downtrend. The moving average also acts as a dynamic level of support and resistance level. In an uptrend, the price often pulls back to the moving average before bouncing higher. Similarly, in a downtrend, the price will often pull back to the moving average before moving lower. Now let's combine the moving average with the RSI setups to identify high probability trade opportunities. Here we combine the RSI EMA Crossovers setup with the moving average. We see that the price was trading above the 50 moving average, and the moving average was sloped upwards. This is a sign that the price was in an uptrend. Then the price pulls back to the moving average, and the RSI moves below its moving average. When the price touches the 50 moving average, we expect it to find support and make an up move. Since the RSI is below the moving average, the momentum is still considered to be bearish. On this candle, the RSI crosses above its moving average and we enter a buy trade here. We keep our stop loss below the moving average and target a 2:1 risk-reward ratio. Here is another example where we add the RSI pullback setup with the moving average. The price breaks above the 50-period moving average and starts trading up. The moving average is sloped upwards, therefore we can confirm the price is in an uptrend. The RSI is also trading above the 50 line, which adds to the uptrend bias. The price then pulls back to the moving average and touches it. We expect the price to bounce upwards from the moving average. We also see the RSI pull back to the 50 level. Again, the price often bounces from the 50 RSI level. This is a confluence. So we enter a buy trade when the RSI moves back above the 50 level. We keep our stop loss below the moving average and target a 2:1 risk-reward ratio. This is how you can use the RSI for trading. It's all about adding layers of confluence to create high probability setups. We go even deeper into the RSI inside the Prime Trader program. Links in the description below. If you found this video valuable, please leave a like and subscribe to our channel to never miss any of our new videos. See you soon!